Hi, everyone. Welcome to today's session. I am Ritesh. I head the investment advisory business at SIFE. Today's topic is the 6 principles of investing. And today's session will be led by Francis Ball, who is the head of corporate partnerships at SIFE. Francis comes with 15 plus years of experience within the wealth management industry. And prior to joining SIFE, Francis worked for Aon Hewitt, one of the largest corporate employee benefit partners globally. So I will hand it over to Francis now, and throughout this whole presentation, I will moderate all the questions that keep coming in. So feel free to post any questions onto the Q&A box, and I will direct them as and when they come to Francis, and we'll continue from there. So Francis, over to you.
Thank you, Ritesh. Thank you for that lovely introduction. Okay, so as Ritesh mentioned, today's topic is how to make your money work for you, and we'll be covering the 6 principles of investing. So really the aim of tonight's webinar is we're going to be taking a bit of a step back away from the technical and specifics around investments. So we won't actually be covering SIFE and its investment methodology in detail. Rather, what we're going to be looking at today is some of the key fundamentals and high-level principles of investing, which should help guide you on your investment journey. The reason why this is important is because as investors, we often get the urge to jump straight into the details without first stepping back and considering the big picture and some of the basics and essential must-knows behind investing in general. Okay, so before we get started, it's important to recognize the problem with investing. Interestingly, these are the same problems we at SIFE seek to address. But the first problem with investing is that many investment options like mutual funds, unit trusts, investment-linked insurance plans often underperform against their benchmarks or don't quite do what they were meant to do when they were originally sold to you by whatever agent or rep, which leaves investors a little bit frustrated and ultimately unhappy, which then means that they start to search around for alternatives. Another problem is emotion and bias creeps into the decision-making process when it comes to investors, as we all want to believe that we are so our experiences make us biased and overconfident and also underconfident when it comes to markets and investing. In terms of investment options available especially around investment products, historically there's been a lack of transparency around some investment products, around the terms and conditions and then subsequently the fees, which can often be hidden, which then what's happens is then that impacts on the level of trust that the investor has with that particular investment product. If you can find the fees, you'll often see that they can be high, which can make investing all amounts, but investing especially with smaller amounts uneconomical. All amounts, or especially large amounts, high fees can also provide quite a significant headwind or drag on your underlying performance. Okay, so let's get into the 6 principles of investing itself. So principle number one is that it often pays to invest today. So what do we mean by that? Let's consider an example. Let's consider this example with Jack and Jill, two investors. And we pose the question, who will have more money by age 65? Now, Jill invests $10,000 every year. She invests from age 30 to age 40. And over those 10 years, she invests a total of $100,000. Jack, on the other hand, he also invests $10,000 every year, but he only starts when he is 40. So 10 years later than Jill. What he does is he starts investing when he's 40. He invests $10,000 every year. And he continues doing this all the way up until he is age 60. So 20 years in total. So he invests in $10,000 every year for 20 years. The overall total for that is $200,000. For the purpose of this case, we've assumed that they both achieve the exact same rate of return, which is 8% per year. Now, the question is, who will have more money by age 65, Jack or Jill? So the answer is, surprisingly, Jill. So Jill, even though she overall invested was half that of Jack, she ends up with the higher overall pot size of over $1.1 million there. A significant amount more than Jack, actually, over $370,000 more, to be exact. So what's actually happened here? So effectively, what we are looking at is the compounding effect over time. Now, Jill, even though she had invested less, had a significant advantage of an extra 10 years head start over Jack. Now, Jack, even though he invested twice as much as Jill, ended up with almost a third less in his overall pot than Jill at age 65. So the takeaway here is that starting sooner will result in a better outcome. Even if, in the case like Jill, you're investing less, it still pays to start sooner and earlier. Conversely, actually, if you look at the case for Jack, there's actually a cost factor to the delay in his starting investing journey. So because he delayed by 10 years, the cost to achieve the same outcome as Jill, so if he wanted to achieve the same pot size, which is 1.1 million, Jack would have had to invest significantly more than the 200,000 over those 20 years for him to achieve the same outcome. So the takeaway here is that the earlier you invest, the more you accelerate the rate of compound interest for your investment. Start sooner rather than later. And even if you only invest a small amount regularly, it does add up over a long enough period of time. Okay, so investment principle number 2 is don't put all your eggs into the one basket. Now, people might be familiar or have heard this term or expression before. Now, in the investment world, this really applies to diversification. Now, what you're looking at here is a very colourful and busy slide, but there's a reason for that. Now, on this slide, each column represents a year, and each colour represents an asset class. Now, the higher the asset class, the better performer it was in that particular year. Conversely, the lower the asset class, the worse that it performed in that particular year. So what you can see is that there really is no consistent year, no consistent year-on-year best performing asset class. There are some asset classes that feature a couple of times at the top as best performing, but those same assets that were at the best performers are subsequently the worst performers the very next year. So what the chart really shows is that it's impossible to predict which asset class will be the best performer each and every year. And why this is important to know is that it can often be dangerous to your finances to select asset classes that are based on the performance of the previous year. So what should we do instead? And this is where the best course of action in terms of following diversification comes into play. And diversification was made famous by an economist and Nobel Prize winner Harry Markovich, who famously said that there's only one free lunch left in finance. So what he meant by that is that if you follow diversification as a strategy, it doesn't cost anything to deploy, and you can benefit from that. The principle here is that you can't really, kind of control or predict asset class winners, but you can control through diversification, you can control risk, and this will help you stay invested. Okay. So looking at principle number three. Principle number three is managing risk first, or manage risk first before returns or over returns. So this is obviously a recognizable figure, Mr. Warren Buffett here, and equally famous quote from him stating that rule number one should be never to lose money, but rule number two should be never to forget rule number one. So what is Warren Buffett really alluding to here? And it's this idea of risk. Now, if we were to look a little bit deeper into this, and you can see from this slide the gold bars. So these gold bars here show different percentage dips in the market. So a 10% dip in the market, a 20% dip, a 30% dip, and so on. And then the blue bars show the respective percentage increase needed to restore you, if you'd suffered that dip, to restore you back to the original level. So, for example, if you were to suffer a drop in the markets, in the stock market of 30%, this would mean that you would need to recover or rebound a percentage of 42.86% in order just to recover back to the original starting amount. Now, that actually is quite a big ask, and it's going to take a little bit of time unless it's a very super sharp V recovery. So what this means that if you fail to manage risk, the recovery can just be so much harder for you. And effectively what that will mean is that it will take pretty much all of your willpower not to intervene, not to, as an investor, not to switch or change, or to change to something else, which ultimately would harm your finances. So it's basically a test of discipline, that if you did suffer larger losses, then it would take a lot of discipline to kind of stick with it to make that big recovery. On the other hand, if we were only dealing with smaller losses, it means so much less of a burden in terms of coming back to the original level. So now this is important because, like I mentioned, emotion and bias very much comes into the picture when investing, and human emotion of fear definitely kicks in when we start to lose money. Therefore, if we are able to manage risk and minimize losses to a degree, it means that we are much less anxious about achieving the high rates of return needed to recover if we'd have suffered a big kind of drawdown losses, which in turn obviously means that we can much more likely to stay the course and stay invested. As I mentioned, is important. On the subject of staying invested, so this is principle number 4 here. I mean, what we mentioned, so principle number 4, stay invested, or also being invested as a principle, directly relates to, again, to the emotional side and the biases that challenge us as investors, because it takes a lot to fight our emotions in periods of market turbulence. So this is not an unfamiliar concept, but this is definitely true. So it's really, the focus should lie in your time spent in the markets themselves, and not really focusing too much on timing the markets or trying to guess when the correct time is or isn't to go in and out of the market. So what this chart shows is that how a notional amount, a notional investment of $10,000 here would have been affected if the best 40 days were missed in that period. So we're looking at quite a long period here of 17 years, 16, 17 years. So it's a little bit like a fear of missing out chart, or a FOMO chart. So this example particularly shows the global equity MSCI World Index market, but the same principle applies to any other equity markets. Just the figures would look slightly different, or to that fact, any mixed asset investment as well. But it's important to note that this applies, this same kind of principle here applies to whether you are watching or waiting on the sidelines, or whether you are actually already invested in the market. The same principle holds true. So if you were holding back from getting into the market because you wanted to see what the markets might do, you actually might be doing more harm than good, because sitting on the sideline and waiting for that kind of perfect moment, you might be missing one of the 40 best days in this particular example, and actually be doing more harm financially, more harm than good. That's not to say, of course, jump in now with every single dollar that you own, of course not. But if you've comfortably covered your emergency funds, so emergency funds meaning an amount typically between 3 to 6 months of your outgoings, or whatever's comfortable for you to cover your short-term expenses. So if you've covered those, comfortably covered your emergency money, and you are going to invest anyway, then your goal really is to maximize your time in the markets, rather than trying to time the markets, and time the markets meaning second guess what they're going to do. So the key takeaway here is that no one really, this is looking back historically at the 40 days, but if we to kind of, stand this point in time and look forward over the next 17 years, no one at all, it's impossible to predict the next best 40 days in the next 17 years ahead of us. So the takeaway here is that no one can predict the markets, and being on the sidelines is actually damaging to your longer term finances. So when it comes to investment time horizon, which I kind of alluded to there in the previous slides, is the longer that you can spend in the markets, the more effect that you would diminish your risks over time. So what we can see here on this slide is the grey columns that run along the x-axis, 1, 5, 10, 15, 20, 25 years, represents your time horizon. Now, if we were to only invest in a time horizon of 1 year, so that's the first grey bar, the outcome of investing in that 1 year could be 86.93% of growth, or actually it could be negative 36.16% on average. So quite a large spread, quite a large variance if you have a super short 1-year timeline, and obviously 1-year timeline is not advisable to investing. However, now if you look at a time horizon that's much longer, so now if you look at 15 years, 20 years, 25 years, what you'll see is the worst case. Now the worst case is denoted by the red line here. So the worst case in terms of return over 15, 20, and 25 years is 5.61, 6.66, and 6.95 of positive growth. So what this means is the chances of a negative return actually get significantly diminished in terms of they get eradicated beyond 10 years. And even kind of turn positive between 5 and 10 years. So the worst case scenario is that you would be positive anything after 10 years. So I think the message here is that the longer time horizon is, it really is your friend. And when it comes to having or trying to have a successful outcome, when it comes into investing, the key really is time to mitigate risk. Okay, so principle number 5, which is minimizing investment costs. Okay, so what do we mean by this? So minimize investment cost is trying to be as efficient as you can with your choice, your investment choice. Now, when we at SIFE always talk about investing, we are very much in the passive investing camp, so we utilize ETFs as our investment vehicle of choice. But now if you compare ETFs or passive investing against its older cousin, active investing, you can actually see from this chart, there's actually a dual cost nature going on. So what we can see here on this particular table is 3 different fund sectors. An example of an asset active fund manager, the shaded area in red, and an example of ETF and the figures in gold. So on this particular table, if we were to kind of pick one out of those 3, in this case, maybe just pick on the Asia ex-Japan equity, so the middle one here, and zone in on that particular market. Look at the active, and this is just one example. We picked one active manager fund manager here, the Nikko AM Shenton Asia Pacific Fund. If we were just to zone in on this particular fund, we could see that the 10-year average, so 10-year annualized return is 7.23. Okay, not so bad. So we look at then the fund TER, which stands for total expense ratio. Now this is the actual cost component of using Nikko to invest into that particular fund sector. Now, if then we kind of compare this to its ETF counterpart equivalent, so that would be the iShares MSCI All Country Asia, ex-Japan ETF, quite a long name for an ETF. If we were to compare it to that, we would look at the cost, the ETF TER, which is total expense ratio, of being a fraction of the 1.85 that Nikko charges. So the iShares would, the ETF TER would be 0.65, which is a third lower than the active manager equivalent. So also on top of that, then you've actually got this dual currency, dual cost element happening at the same time, which is this notion of underperformance. So Nikko underperformed against the index, which in this case was the iShares MSCI or World Country, and the actual index itself produced 9.92%. So there's almost a doubling effect going on. So this means that this dual cost effect is going on here, and not only are we seeing a difference in the ETF cost, but we're actually seeing versus active fund, which is the price you pay, but we're also seeing underperformance as a cost too. A bit more of an extreme example here is if we look at the last the last one on the table, which is the US market, so the US large cap value equity market, that particular sector. We've got Franklin Mutual US Value Fund. This particular one versus its ETF counterpart, which is the S&P 500 ETF, that mutual fund is actually 0.09 in terms of its TR. So it's actually a factor of 20 times cheaper than using the active manager counterpart. Just by simply looking at ETFs and passive investment. Now, the reason why all of this is important is that really, the principle behind this is to minimize investment costs. And these fund costs that you would face from an active fund manager, they do eat away at your investment. So let's take a look at an example of these fees in action. So here we've got two investments that start with the exact same amount, $100,000, and run for the exact same period of time, 25 years. Now, the first one on the left, that $100,000 has returns over that time period of $330,000. So quite significant. That's represented in the green shaded area. Now, if we looked at the one on the right, so the parallel investment that started with the same amount of the same time period, if we look at that, where there's an annualized 2% fee, or maybe a TER if you use an active managed fund, you can see here that same $100,000, you've got compounding the effect working against you. So in this case on the right, the costs of the 2% fees add up over the 25-year period to, in this particular example, $170,000. So that represents, about half of your returns if you were to do that with, minimized or no costs. So this is the amount that you would actually lose in terms of costs, and these would erode a big chunk of your overall earnings or your overall returns. So it's very important to be aware of the costs when you start any kind of investment. Very important to be aware of the costs you pay, and to look at and zone in on and minimize costs wherever possible. Okay, so principle number 6. So align investing with your goals, or align investing with your personal goals. So what do we mean by this? So it's having a goals-based mindset when it comes to investing, really. And it's explained quite well by this particular visual. So in this particular visual, what's happening here is that when you try to invest, what it shows is when you try to invest without a clear goal, especially in uncertain or extreme times, volatile times like we're experiencing now, what happens is people don't know quite what to do. So as a result, if you don't know what to do, the result is that they end up doing nothing. Quite frankly, they end up doing nothing. So in this period of kind of paralysis. And as we know, as we've covered earlier in the slides, in the earlier slides, the idea of actually doing nothing or even deferring can actually financially harm you in the long run. So investing with goals-based mindset, especially true for younger investors starting their investment journey, or those who are doing regular monthly or regular periodical investing, will greatly improve your investment outcomes if you approach it in this mindset. Okay, so how do we do this then? So how do we use a goals-based mindset? So the key here really is to try to think about your investment as a financial destination. So rather think about investing as a final destination. And then once you have a destination, is to be then smart about it. So SMART, some of you might recognize the acronym. So this stands for specific, measurable, achievable, relevant, and time-based. So these are factors that go into your goal. So much like a profession in your professional life or your careers, our bosses, supervisors, line managers will often sit down with us and plan what we want to achieve in the years ahead. So the same logic applies with goals for your investment, which is very similar. So in that you should really plan your investment journey with the end in mind. So what do we mean? So specific, your goal should be clear, have some detail, and explain what you're going to do and how you're going to do it. Measurable, meaning that your goal should be obviously measurable, tangibly, to determine how successful or how on track you are to your goal. It should be achievable. Your goal should be definitely within grasp to be able to motivate you. It should definitely not be impossible. For example, if you were very close to retirement, so if you were 5 years away from retirement and you decided your financial goal was to get a retirement pot of $10 million. But the problem with that is that your wealth at that stage was only $500,000. Now, in the course of 5 years, turning $500,000 into 10 million is a pretty bit of a large ask. So it's got to be achievable to be smart. Relevant. Your goals must coincide with your overall objectives. You know, they must kind of fit within the bigger picture. Don't plan, so for example, don't plan to buy, say, an investment property when you've already committed to paying for your kids' university fees, for example, at the same time. So this has to be relevant for you and your situation and your family, if you have family. Lastly, time-based, a bit self-explanatory, but time-based meaning that your goal should operate within a specific time limit. So just to give you an example of what SMART goal would look like, a particular example may be for you as an investor to take a career break at age 45. Take a career break that lasts for 2 years. You've gone to the trouble of quantifying how much income you would need over that period of 2 years. And for you, for your particular family, to cover your family bills, expenses, etc., you have calculated or quantified you need rough $6,000 per month. So once you have got your goal, you can then start to work backwards and devise a bit of a strategy of how much do I need, and then subsequently, how much then do I need to invest to achieve that goal? So if you look at that particular goal, the target amount of money needed to fulfill that goal would be $144,000. Now, then if we work backwards and say, well, how much do we then need to invest to realize that goal? We're assuming a rate of return of 6% here. The investment commitment or the investment required is actually only $310 per month to achieve that goal, to achieve that target, which ultimately will achieve your goal. Now, in this particular example, this particular person was age 25, so they had a 20-year kind of timeline to kind of achieve that goal, but the same principles apply for any time duration. So what you can do to kind of assist you with these goals and then strategy is to take advantage of forecasting tools. So that's why they're there really. It's not a guarantee, but it's to help you with determining, you know, how much you would need to set aside or invest over a period of time to then achieve your particular goals. There's many forecasting tools available, so take advantage of them. Okay. So how then do we get started? So what are the tips to actually, you know, take some of these 6 principles and put them into action? So the first example here, and this is something that we've already covered in terms of the costs of delay earlier in the slides, but let's have a look at this example in terms of income, retirement income terms. So in this particular example, we've got somebody aged 40 who does an initial investment of $30,000. They choose a particular risk rating of 15%. They then subsequently add to that initial investment over a monthly basis. They add $1,000 each and every month until they reach retirement. So this particular case, they stated they want a retirement of age 65. Now, what then that translates to be in terms of a retirement income at age 65 for Priyanka is just short of $6,000 a month if we adjust to inflation. Okay, so very straightforward calculation there. But what if we, or Priyanka was to start a little bit earlier than age 40? So if she was to start 5 years earlier, what would be the impact here? So as you can see there, if she was to just start 5 years earlier, she could increase monthly retirement income to $8,600. So that is quite a significant jump, over $2,000 there, or over a third. So she can increase monthly retirement income by over a third just by starting a little bit earlier. So again, what's happening here is we're taking advantage of compounding effect. This is coming into play. So you're investing for a slightly longer period. So it really proves that time is your friend when it comes to achieving better results. In this particular example, we've got Alexa, age 38. Now, Alexa started with a different initial investment amount of $100,000. She chose a risk rating, downside risk rating of 17%, and then subsequently added to that on a monthly basis of $500 a month. She chose a little bit of earlier retirement age, so she chose to retire at 55, so a little bit of a shorter time period by which the savings, so investments could accumulate and grow. So the calculations prove that she could derive a monthly retirement income of around $3,200 a month, adjusted for inflation. But what if she was assuming it was affordable for her to do so? What would be the effect of upping the monthly amount? What impact would it make? Now, if she was to start with $1,000 instead of $500, you can see that here that she would have a significantly higher amount of retirement income. So nearly $4,500 versus $3,200 there. So really, if you have surplus cash flow to accommodate saving a little bit more, you can significantly make dents and inroads and improve the financial outcome retirement if you were to adjust your recurring or regular monthly amount. If you make it a disciplined process over that period of time and stick with it, you will achieve your goals. Okay, so last example is John. John is age 35. His initial investment is $10,000. His downside risk is 21%. His monthly amount investing is $400. Now John retires at age 65. So this is a 30-year timeline for him. If you do the calculations, it works out to be just below $5,000 a month, adjusted for inflation. But what if John was, assuming it was within his risk tolerance to do so, changed his risk rating, as he actually has got a longer time horizon to play with. In this example, his time horizon is 30 years, which is quite a long time horizon. So when you have a longer time horizon, it really allows you to take a little bit more risk because the losses can be recovered, or temporary losses can be recovered over time. So if it was within John's risk tolerance to do so, he could increase his risk rating from 21 up to 25 and get a better outcome of $6,000 in terms of his monthly retirement income. So it's quite a significant jump there from 4,800 up to over 6,000. It's a jump by 25%, and really, going from that level to 6,000 without actually utilizing any more of your own investment or paying in any extra really is quite interesting to see. Okay, so in terms of a bit of a summary from the principles, this part of this section of the presentation, it really does pay to invest today. So the earlier you invest, the more that you can accelerate the rate of compound interest and bolster your investment. So recognizing this from the start and starting sooner rather than later, even if it's just a small amount, start sooner rather than deferring or sitting on the sidelines. Number two, don't put all your eggs in one basket. This is referring to diversification. So have a diversified portfolio made up of different asset classes to spread your risk. Number three, manage risks first over returns. Now, market volatility will always exist. That's the nature of markets. Now, the key here is to manage the risk and minimize loss is really the key to kind of creating long-term wealth. Number four, stay invested, avoid timing the markets, as we went through before. Focus really on the time and duration that's spent in the markets. Number five, minimize investment costs where possible, where you can. Be very cognizant, be very mindful and aware of high fees, as they can significantly eat away at your returns and provide a headwind for your investment growth. And lastly, number six, align your investing with your goals. So your personal goals, have a goal, make a plan, and then carry out consistent periodic investing to achieve those goals. Okay, so I might just pause there before I kind of go into a little bit about SIFE. Maybe just pause there to ask Ritis if there's any questions that have come in whilst I've been talking that focus really on the principles of investing rather than SIFE itself, which I'm going to go into in a moment.
Right. Hey, thanks, Francis, for covering all the points. I think great way for people to get started in terms of how to invest, and following these basic principles. It's actually very helpful for people to have a plan if they do not have a plan yet, right? So all of those are great. We have some questions from the audience. I think some are related to all the principles that you have talked about. There are also some market-related questions and some questions specific to SIFE. So I know we will cover the markets and SIFE-related questions in the second half. But let's focus a little bit more on the principles of investing and questions around that. So one of the questions from Jermaine is on the example that you had shared with Jack and Jill, right? And the question is, has the amount considered inflation in 10-20 years, as that will creep up as well and dent your purchasing power, right? So there was this example that you had shared where earlier you invest and the greater that you can sort of generate. So his question is more on inflation, like, do these calculations, take into account inflation?
Yeah. That's a good question, actually, because that particular example, it's a very simple example. So that particular example doesn't take into account inflation, but the same kind of outcome would be would be shown if you were then to factor in some inflation. It would just apply to both Jack and Jill. So you would basically have a very similar kind of result, that in terms that Jill significantly would be in a better off position than Jack. Where we actually, in the last couple of examples that I gave around starting earlier and starting with different amounts and risk, there was actually some adjustments there to take into account inflation, because that definitely would, you're right, Jermaine's right, in terms of it would have an impact on the purchasing power. So it doesn't form a drag itself on investment returns, but more so when it comes to utilizing the proceeds of your investment for spending or retirement or for using it for another purpose, then yes, you're right, it would, inflation or purchasing power would come into play at that point.
Right. I think the important point to note in that particular example is just the fact that you invest early leads you to a much better outcome. Yes, I mean, inflation will have an impact, but it will have an impact on a larger base compared to a much smaller base if you delay your process of investing itself, right? So that's an important thing to note. Francis, one more question. Around the part where you mentioned about comparing the active funds versus the passive investment strategies that we follow. One of the questions is there are also some passive unit trusts that we can, potentially buy, and they do have a lower potential, total expense ratio. So why do we prefer ETFs, per se? So there are some active funds which also sort of track the index, or they are passive, to say so.
I'm familiar with some big names, actually, some big investment houses that do have ETFs and also do have passive unit trust funds as well. So I think, in short, the answer for us and why we prefer or lean towards ETFs rather than unit trust is liquidity and trading. So with unit trusts, mutual funds, typically you can only trade earliest is once a day, and typically there's a settlement period associated with them. Whereas with ETFs, you can trade instantly. So they have a real-time price, and you can look this up at any point in the day. And it allows liquidity, but also kind of you'll be able to trade in and out of them as investors.
Got it. And I think a follow-up, similar question that, what is considered as low total expense ratio for ETF? Are the expenses charged on an annual basis or at the point of purchase?
So ETFs, they are different in that regard to unit trusts and mutual funds, in the sense that they typically don't have a initial charge or an entry charge. Unit trusts or mutual funds typically have an entry charge for you to kind of buy them. This can vary between 2 or 3 up to 5% that we've seen out in the market, which is a significant cost when entering into a unit trust. The ETFs really don't have that at all. So what the NAV or the price that you see, that is typically what you'll buy them at, assuming there's liquidity. So you'll buy them at that kind of pretty much close to that rate. Now, where the costs come into play is that ETFs and even mutual funds and unit trusts do have an ongoing cost dimension to them. And that's really what the slide the table in that slide showed, that on an ongoing basis, those can be up to 2% for unit trust, whereas for ETFs, these can be as low as a few basis points.
Got it. Great. I think a few questions more around how do you sort of construct your portfolio in the first place, right? So what would be a recommended investment ETF mix? For example, for 10 to 15 years of regular passive income. So I think, it goes on to a little bit more goal-based, principles that you were talking about as to, you have a specific goal. Now, for that specific goal, how do you solve for, what are the underlying instruments or ETFs that you need to buy?
Yeah, definitely. I think, you're touching upon gold-based kind of investing there, definitely, for sure. I mean, the other factor to consider is your risk tolerance. So when we talk at SIFE, we talk about risk a lot because it's front and central of what we stand for here. But when you are looking to invest, you should really pay serious attention to your risk appetite. So this is how much you can stomach, when markets start being volatile, which by definition is what they do. So if then you can't really stomach big swings and volatility in the market, then that typically means that you're conservative or risk averse as an investor. You then kind of couple that together with your goals and factor in your the time horizon as well for those goals, and that then really kind of gives a pretty much 80 or 90% of the picture of what your portfolio should look like, or what are the constituent parts that your portfolio should look like. Now, I'll cover this in the next section, but here at SIFE, we can help you a little bit with that journey, so you don't have to kind of think of that alone. So we have a risk analyzer, which helps guide you, after asking a few questions, helps guide you in terms of where we recommend that you should sit and the portfolio mix that you should go for, given your particular risk tolerance and your goals and profile.
Got it. All right, I think that covers all the questions for now with respect to the principles of investing. I think there are a lot of questions related to, either the markets or in terms of, how SIFE could be helpful. So maybe why don't we actually start with, an introduction to SIFE, and then we can take over those questions as well.
Yeah, perfect. Thank you, Ritesh. So let's, kind of crack on and cover the last couple of points about really how, given those principles and given if you're in a position of getting started or wanting to get started, how can we at SIFE help? So basically what we do at SIFE, we have two different portfolio offerings here. The first one is what we label as SIFE Global. Now, SIFE Global is pretty much adheres to, nearly all 6 principles that we've gone through before, in that it's a truly diversified portfolio with the aim of focusing on long-term wealth generation and wealth maximization. So it looks at constituent parts of different asset classes, like I was saying in response to that last question, is there are different risk portfolios. In fact, there's 11 of them. There's 11 different risk portfolio options available, depending on where your risk tolerance, or your goals and objectives kind of lie. But each one of those 11 risk options have 3 levels of diversification. So first one being over asset classes themselves, the next one being geographies, and then the third one being different sectors as well. Now, in terms of how they look and how they grow, they've actually outperformed, annualized over the last 10 years, outperformed the Morningstar benchmark. So they actually do what they say in a tin. So, having the benefit of diversification actually gives you that level of security in terms of performance. Now, the second portfolio option is what we call SIFE REIT Plus. Now, this is a little bit of a different proposition in terms that the focus really is on income generation. So it's a portfolio, as the name implies, it's constituted of exclusively REITs, or REITs with a mix. It's Singapore denominated, and it tracks the iEdge S-REIT 20 indexed by the Singapore exchange, the SGX. Really, the focus here is to generate dividend yield, and had dividend yield over 5% last year. So it makes it as an ideal tool or a supplementary portfolio to generate passive income. Now, you can either choose this with risk management, so you do have some kind of risk control mechanism within the portfolio, or you can choose it without risk management, meaning that you will just experience the true highs and lows of the particular REIT market and all the volatility that comes with that. Now, underpinning those two different portfolio offerings are our SIFE advisory team. Our SIFE advisory team really is here to help you understand those two different propositions. So if we do end up running out of time today and not being able to answer all your questions, this is what the advisory team is there to do and to help you with. So you're able to speak with our experienced, qualified, licensed experts, and these are actual advisors from other wealth management and banks, companies that are able to kind of help you review your investments, help you planning with some of your goals, which we covered in the 6th principle is very important, and for you to better understand the different options, what you might be considering. Oh, something's happened to my slide here. Just bear with me. My slide seems to have broken. Just bear with me. Oh, I think I might.
Maybe, Francis, if you could move out of the slide and move back in, sometimes, maybe the way it comes out. I think Francis just freezed, so there might be some problem from an internet connectivity standpoint on Francis's end. So in the meantime, what I can do is let me take some of the questions that have been posted, onto the chat, and then as Francis comes back, then he can start back onto the platform, descriptions and all. So, all right, I think so. Question number one is from Lee. What should we be selling funds when the price are high to buy funds in other sectors that are not performing? So I think the question here is, like, right now, if you look at the markets, there has been a big rally since the market bottomed around 23rd of March. And what has happened is, names or sectors such as technology, healthcare, and all of these growth sectors have really, gone back up quite high. And to the point, or to the extent that right now, some of the other sectors, for example, are still, down to the bottom, right? Like, financials, oil and gas, energy, consumer discretionary, these sectors were beaten down quite badly because there was a demand collapse. So from a surface standpoint, yes, I mean, there is some value attached to, finding these sectors which look distressed, and potentially you can gain access to these sectors by, diversifying your portfolio and having some allocation to them as well. But again, I mean, it's a bit of a view that, these sectors will, because they have performed not so well, so now they will perform well, versus all these sectors which have a secular growth story, right? Like all the tech companies, all the healthcare companies, biotech, and the consumer staples, they are sort of counter-cyclical. So they will remain, resilient through different market cycles. So yes, the prices might seem high, but like, over a longer horizon, these sectors are much more resilient for the new normal that we are observing in the market. So my view would be that it doesn't harm to actually take, some exposure to the sectors that have been really beaten down. But again, how do you choose them is kind of very tricky. And you have to sort of, again, have a view, and essentially you need to do some due diligence in terms of making sure that, what you're picking are the right things, and they will have a sustainable business model when things recover, right? So there is some demand coming back, and some of the sectors are recovering, which have been beaten down, as you can see. But I think, as I said earlier, it is important, not to be picking one sector over the other, but rather have a diversified portfolio. And that's why I think in our setup, what we do is we don't have, allocation to just, technology, or just healthcare, or just, energy. We have a judicious blend of all of these, sectors represented in the portfolio, such that, when one thing doesn't do well, there is, these countering, sectors that will sort of mitigate those situations, and, over the long run, you will do well, right? So hope that answers your question, Lee. Now, another great question regarding our current portfolios, right? So, I mean, we've not covered how the SIFE portfolios look like, but if there are people who are actually SIFE clients right now, we have different portfolio options, as Francis had mentioned, between 5% to 25% risk levels on the global portfolio basis. Each of our global portfolios are composed of 3 different asset classes: equity, bonds, gold, right? And our 15% downside risk portfolio is one of the more famous portfolios and popular portfolios for our investors, because it has a good blend of equity, bonds, and gold as well. And essentially, it on average has a 60-40 allocation. So typically, most of the wealth managers will give you very static asset allocation portfolios, which is 60-40 if you're a moderate risk, 80-20 if you're a aggressive risk, or 20-80 if you're a conservative. So our 15% portfolio on average has a 60% allocation to equity. Now the question really is that, on the current standpoint, our 15% portfolio on average does have 60% equity, but right now the equity allocation is only 17%. So the reason for that is essentially what Francis had covered earlier, where alongside diversified portfolio, we have a genuine focus on risk management. And we, as a strategy, what we're trying to do is limit your downside. So when we are choosing a 15% downside risk portfolio, the mandate is don't lose me any money beyond 15%. Whether the market goes down 20%, 30%, I don't care. I've given you the responsibility to keep my losses contained to a max of 15% drawdown. So that's why what you can potentially see is right now an allocation which is more tilted towards bond. But as you asked KT, as and when we see that the market recovers, and when I see VC, it is not just our own sort of views on the market, but the RE, which is our sort of flagship technology. The way it works is when the market volatility subsides, and that is typically associated with normalizing of market conditions. When the market volatility subsides, that is when you will see that the equity allocation will go back up, such that you participate in the upside as well. Right. So hope that answers your question. If not, please feel free to reach out to us. I think Francis has joined us.
Ritesh.
Yeah?
Hey,
Francis, I was just answering a few questions while you were online. So I think I've addressed a few. So back to you. Let's go on to the slides again.
I don't know quite what happened there. I got a dreaded blue screen on my computer, and it completely kicked me out for some reason. I couldn't get back in. So anyway, maybe
you can share your screen again. Yep.
Yeah, let me go back to sharing my screen here. Okay, so loading. So just having a little bit difficulty loading, actually. Ritesh, are you able to share your screen? Because it looks like I'm having a little bit of difficulties here.
Sure, absolutely. If you could disable your screen sharing, then I'll start sharing my screen. Or we can see your screen. Okay. Yeah. All right. Let me share mine. Yeah. Just hang on a bit. So, all right. Wait. Oops. Sorry about that. Let me find out where the slides are. Sorry about this. Okay. 1 second.
Maybe
in the meantime, maybe
I was going to say maybe I can carry on, because I think I kind of knew which slide was kind of coming up next, and
so or you could take up a couple of questions, Francis, while I load up the slides. So I think one of the questions that people had was, is the SAIF global portfolio USD denominated? If I fund my account in SGD, would I incur significant FX costs? Alternatively, can I fund my SGD for REIT Plus and fund USD for global?
So I'll answer the second question first. The answer to the second question is yes. You can fund your REIT portfolio in SGD, and if you wanted to choose to do so, you can fund your global portfolio in USD. So the global portfolio is available in 2 different currencies, SGD and USD. To answer the person's first question is, will he incur any significant FX charges if you invest in SGD into global? Well, a lot of the underlying, to be globally diversified, we have to look at markets outside of Singapore, which means that we have to look at currencies outside of Singapore. In terms of the ETF market, the largest market is in the US. So a lot of the ETFs that we use are listed in the US markets. So meaning that fundamentally there will be a currency conversion at the point of investing. Now, that will only occur once at the point of investing, and then once again when you choose to uninvest or to kind of redeem or liquidate your investment. So,
hey, Francis, your voice is getting a bit cut as well. So if you could, yeah.
Yes. So, so in terms of incurring any FX charge, it'll only be once when you make the investment, and a second time when it comes to kind of exiting or redeeming your investment. So, and the FX charge is institutional rate, so it's much better than you'd get as a retail client, and I think it's 10 basis points or something along those lines. So, if you're investing for then a 10-year time period, you would only have to incur that twice, which is 20 basis points, which is 2 basis points per year. So it's insignificant in terms of actual incurred cost. Okay, Richard, maybe you've got the screen on.
Yes.
Yes, maybe I carry on from where I left off and really just kind of explain how you get access, I suppose, to S.A.R.T, really. You can get access online, obviously, via a web, but you can also get access to via app as well. So via App Store, Apple App Store, and also Google Play Store as well. Now, we have full functionality on both platforms, meaning that you can fully onboard yourself as a client or explore our site. And the first one, you can actually, and I was kind of mentioning this in response to one of the questions, is you can actually get a portfolio recommendation via either platform. So you can go online, you can complete a few basic questions, a few clicks, and you can then arrive at a particular portfolio recommendation page. Now, at this stage, you will see the entire portfolio recommended to you without even sending over a dollar. So you can actually see up front exactly what you're getting yourself in for. You can see the specific ETFs, or in this example on screen, it's showing REITs. So you can see the specific REITs and the weightings. And you can see exactly everything that you will want to, or what you need before you actually start investing. You can then, if you're happy with that, you can then click on Confirm Portfolio, or you can then choose a different portfolio risk, depending on your preference. And then you can go in and that's it. And then you can start investing. So what we also have just go back a second. So what we also have is a forecasting tool, which is links a little bit to what I was saying about the goals-based investing, and using forecasting tools really to kind of help you plan and understand and strategize how you're going to achieve your goals. So on this, you can kind of plug in a few different numbers, change the amount, change the initial starting amount, change the monthly amount, change the risk if you want to kind of play around with different portfolios and get a kind of output or a range of outputs in terms of what your likely investment outcome will be. And then lastly, you can monitor and see exactly what your portfolio looks like on the go. Very easy monitoring. You can see the interface is very clear. You can see exactly where you are, what's gone in, how much it's worth, what are the charges, what the percentage gross, etc., on the go. So this is accessible 24/7, and you can add funds and manage your account from there. Next slide, please. Okay, so this might have come up in the questions. So in terms of how do we work as a business then? So what do we save? Where do we make money? And how do we charge? So we may try to make it very simple for our clients in terms that we only have one fee. So we have what's known as a single charge pricing structure, which starts from just 0.4% per annum. It goes up to 0.65% per annum. Now, that's a single fee, and that's all inclusive of everything that you see below. So there are no hidden charges. There are no trading fees when it comes to investing or rebalancing. There are no entry or exit charges. We touched upon entry charges when we talked about unit trusts a little bit early on. There's no minimum balance, which is very interesting because unit trusts often do have minimum start balances or minimum starting amounts. So that means you can start with $1 if you choose to do so. Whether you actually want to do so is a different matter because it wouldn't make much sense just to invest in $1, but you can do so if you choose to. And there's no minimum balance of keeping that in there. We have unlimited withdrawals in full or in part. that are free at any time, so you can take your money out whenever you choose. There's no minimum duration or lock-in period. We have unlimited rebalancing, which means that you can take advantage of our portfolio recommendations and rebalance where necessary, unlimited for free, and also take advantage of the low ETF management fees. Next slide, please. In terms of amounts, so we have a few different tiers in terms of pricing tiers. Now, as mentioned on a previous slide, you can invest with $1. There's no minimum investment actually to invest, so you can start with $1. So if you did that, you'd be classified as blue tier. So blue tier is anything up to $20,000, so $0 to $20,000, and our fee for that tier is 0.65% of whatever's in your account on an annualized basis. If you were to step up above 20,000, up to 100, that would be a black tier. Now, black tier is a fee of 0.5% annualized. And then if you were to go over 100,000, then you would go into our gold tier charge, which is 0.4% per annum annualized. There are different features for each of the tiers, so blue, black, gold, and then also platinum, which you get a little bit extra features if you were over $50,000. But if you were a blue tier investor, you would get access, initial access to our investment and advisors for the first month to help you with the point I made earlier in terms of the investment options, a little bit of goals, understanding your requirements, and you'll get full access to them to help you with your starting your investment journey. We also have a nominal fee if you want to do a financial planning session of $209. If you're a black tier, you would get access to our financial advisors on an ongoing basis, and you'd get a financial planning session included free within that. If you were then a gold tier, you'd get your own dedicated advisor and get quarterly financial planning sessions. As mentioned, for any larger amounts over $500,000, you would get a comprehensive kind of analysis of your investments and reports on other investments not held with S.A.R.T. Okay, next slide. So we often get asked this question, so I might be preempting some of the questions that might have come in, Ritesh here, but we often get asked, how do we then compare versus, hey, you know, I just want to pick some stocks myself, or I just want to pick some ETFs, or I just want to do unit trust investment on my own. So we classify those type of investors as DIY or do-it-yourself investors. So we often get asked, how do we kind of compare against them? So a very obvious one, as mentioned earlier, is that we have no minimum investment amount. So you pretty much can start with anything you like. Whereas if you were to start investing into stocks or ETFs or even unit trust, there's often a minimum subscription amount or minimum lot size or minimum number of units that you would need to start with before you can get going. So it can obviously sometimes be prohibitive, especially if you're investing on a monthly basis. With DIY investing, you need a CDP, a brokerage account via SGX. With S.A.R.T, you don't need that. We do that all for you. There's no requirement there. The actual time to get up and running and get started with DIY investing depends on which type of investment option or product that you look at, but it can take several days. There's quite often paperwork involved. There's approval process with that paperwork involved. Might be a meeting with a particular rep or an agent involved. So all of that can take several days. With S.A.R.T, as seen from the different platforms on app or online, we can onboard instantaneously or almost instantaneously. So, you know, 3 minutes, I think, is pretty good in terms of onboarding. And if you've got your details registered with MyInfo, MyInfo, you can not even have to enter any personal details. You can just click on MyInfo and your personal details will be uploaded for you onto our platform. DIY investing, there's no kind of risk management. So all the risk is on you. So you've got to take the rough with the smooth. With SIFE, we have that level of risk management going on. We also have auto rebalancing and optimization, whereas if you do it on your own, you've got to be able to rely upon your own decisions, which may work out, which or may not work out, but it's all on you. SIFE, we do that for you. We also have automatic dividend reinvesting. So if a particular ETF or REIT paid out a dividend, that would be automatically reinvested by SIFE for you. Now, if you were to hold that ETF directly or that REIT directly, the dividend would typically get paid to your bank account, and you would need to build up a little bit of a minimum amount before then you could reinvest that back into the REIT or ETF or whatever your investment vehicle is. We don't have any brokerage fees. Brokers, they typically have a platform fee when you come to buying or selling or to do with a transaction. That can be 0.5% typical each time. And our management fees, as we covered earlier, starts from 0.4% annualized, whereas with unit trusts or other mutual funds can be higher or up to or over 1.5% annualized. Okay, just a little plug for our upcoming webinars here. We have webinars every Thursday. The next one coming up is investing in REITs. So if you've got any specific questions about REITs, this would be the ideal webinar for you. Really focus on REITs and using that for passive income. So that's our next webinar coming up. And lastly, we have a promotion code, a promo code that's available for the viewers and the audience today. You can receive up to a $100 bonus if you were to complete, next slide, Ritesh, if you complete our survey. Please use the QR code to get the survey. So if you just scan that on your phone, on your QR reader, it'll take you to the survey. Come and complete the survey, leave your details, and we will give you the promo code for the bonus, which is up to $100, depending on the amount you invest. Okay, so that's it in terms of the slides. We'll just kind of open back up for Q&A now. I'm just conscious of time, so if there's any questions that we can kind of fit in before we have to kind of wrap up. Ritesh?
Yes, so all right, let me look into the questions. Is the minimum investment a lump sum, one-time investment, or can it be accumulated? For example, if I invest an amount every month and finally reach 100K, can I get access to the perks that come with gold status?
Yes, the answer is very simple. The answer is yes. So as soon as you invest, as soon as you invest and reach that threshold, then you would qualify for the respective tier. So in that example, you would qualify for 0.4%.
Right. One question, I think you addressed it a little bit earlier. How do I open an account with SIFE?
Yeah, very easy question there. So you just go onto sife.com if you're on your laptop right now, or if you have your phone, your Android or your Apple phone, just go onto the respective store, download the SIFE app, and then you can do that via the app, or you can do that online. You click on the Get Started button, it will take you through a series of questions, and as I mentioned earlier, it would then give you a recommendation. You say okay or not, and then it would take you to the stages to how to invest.
I think a few questions regarding, I think a little bit on the markets, but I think more on, lump sum versus dollar cost averaging. So, people have been, cognizant of the current market situation and the uncertainty surrounding it. So, there is a natural question that should I, if I have money right now, should I put it all in, or should I dollar cost average? And, what would be the right strategy? And similar lines, I think another question is, my monthly investment with SIFE, should I invest one time monthly or invest little a week throughout the month, right? So if someone is already DCA within, if they've set up monthly contribution, should they, further divide it into weekly contributions?
Yeah, the second question is interesting. I mean, it comes down to practicality, really. Yes, you can do smaller ones in more frequency, but it comes down to, practicality. If you If your online banking can facilitate that, then yeah, that is, an option. If not, and you've got to remind yourself to do that every week, then it can be a little bit troublesome to do so. Coming back to the first question, we often kind of encounter this a lot. So I might, ask you as well, Ritesh, your thoughts on this. But, I think for me, the whole subject of dollar cost averaging versus lump sum, which is better, I think it comes down to, what you define as better. So, I think the reason dollar cost averaging is a thing is it really is a risk mitigation technique. So what I mean by that is, if you do have the money and you're wanting to kind of make a decision whether to do it all now or to do it piecemeal over a series of months, I think the first question you need to ask yourself is, what is your risk tolerance? So dollar cost averaging is inherently less risky. It makes sense, really. Logically, you're feeding money at different intervals, and those intervals will have a different kind of market value at that particular point in time. Whereas lump sum investing, really, you're all going in at that particular point in time. So you're at the mercy from that particular point in time onwards of following whatever the markets or your investments kind of do. So it's not really a case of, is one better in performance than other. It's more to do with, where does your own kind of risk tolerance lie? If you're risk averse or a little bit more conservative, then dollar cost averaging might be more suitable for you. If you're a little bit more, adventurous or, aggressive in terms of growth, or aggressive in terms of risk profile, then you might want to choose doing lump sum. Ritesh, would you add anything else into that?
No, I think covers it quite well. Let's quickly move over, to a few more questions. I think, let's give it another 5 minutes. So I'll try to, jump through some of the questions here. And sorry if you're not able to, go through all the questions. Folks, we will, take them up offline for sure, or just leave those questions in the Q&A section, and we will, get back to you, or schedule a call with one of our advisors, and then it'll be a much more fruitful discussion as well. So another question, I think, there's a valid concern that a lot of people have with the recent closure of one of the robo advisors in Singapore, and the concern around what if a similar situation unfolds for SIFE? How do you ensure that my funds are secure?
Yeah, it's a good question, and yeah, it's obviously naturally going to come up in times that there's economic uncertainty. So, I mean, first and foremost, it's important to kind of understand. We didn't really cover that today, but in terms of our license that we have with the MIS, we have what's known as the Capital Market Service License, which is the top kind of license given out to people in our industry, and I think we're only one of a small handful outside of banks that kind of hold that license. And what that means is that effectively it holds us accountable to the highest standards by the regulator in terms of what we can and can't do. And something that we definitely can't do is hold clients' money in our money or in our books. So anything that's invested via SIFE doesn't even touch SIFE's operating accounts or our balance sheet. So your money isn't on our balance sheet. So in the very unlikely event that anything was to happen to us, that your money first and foremost would be separate and away from our money as a business, as an operating company. Which would mean that you'd have certainty and peace of mind. And the way that's done is through custody accounts and trust accounts. So meaning that if then something would happen with us, the money would be held in trust or custody for your benefit. Now, what may happen then if then that particular incident would occur is one of two things. Either you could kind of withdraw your money because, like I mentioned in a few of the slides, there's no kind of lock-in periods, there's no minimum time periods. You can access your money at any point in time, so you could make a full withdrawal. A little bit more of a hassle, I suppose, in terms of the investor side, in terms you have to withdraw and then reinvest. But if you do those simultaneously, there's not that much interruption. But what's more likely as a scenario, if the unthinkable ever happened, would be we would kind of be kind of taken over, or we hand over to another fund management company with working with the MAS to kind of make sure that's done in a kind of regulated way. So what that would mean, and you would have then the choice to kind of continue under their management or kind of to withdraw. So the choice is down to you.
Got it. So a couple of questions, I think, to round up. I think these are, again, questions that we get asked fairly often. Number one, like, how does SIFE stand vis-a-vis all the other robo platforms in Singapore? How do we differentiate ourselves? And I think a little bit more on the pricing, where, if we can summarize what is the total cost of investing into the global portfolio, as well as on the REITs portfolio. For example, the global portfolio along, outside of our management fee, there is the underlying ETF management fee. But on the REIT portfolio, we directly buy into the REIT, so there is no such fee, right? So if you could just like quickly summarize that, and then, round it off with like, why should people consider SIFE as an investment platform for their, long-term goals?
Yeah, in terms of the total fees then, so as I mentioned in the earlier slides, so SIFE, we as a company, as a business, we only have one fee, and that really depends on how much that you invest with us. So that varies from 0.65 down to 0.4, depending on how much you invest with us. So that's our fee. Then what is a fee that would be on top of that is the actual fee within the ETF manager itself. So the ETF is run by an external company. It's not, we don't run our own ETFs. So whether that be iShares or Vanguard or whatever ETF it might be out there, they have their own specific fee, and that ranges from 0.05 up to 30 basis points or 25 basis points. So there's that to consider as well. But that's unavoidable. If you're going to be investing in ETFs, which in itself is a low-cost investment vehicle, then that's the kind of that's the fee that you have to kind of bear in mind. The last one is, we've covered this a little bit with the currency conversion, and that would only apply when you kind of invest and when you disinvest, and that's approximately at 10 basis points. So you split that between the number of years that you invest, and it's kind of negligible. So then to answer, or to wrap up and answer your first question, in really what makes SIFE different from our peer group, I suppose it boils down to three things really. First and foremost is, we've not really had a chance to go into this in detail today's session, but the first thing is our risk first approach. Now, we do go into detail on this in our other webinars, but today it was more high level, talking about principles. But our risk first approach via our ARI methodology is really the underlying belief system there is that we don't believe that you can actually control markets, or you can predict returns, or you can kind of guarantee performance. But what you can control is risk. So we truly believe for that. We stand for that. So if we can control risk, and then we can optimize and get the better outcome. So that's number one. Number two is innovation. So I would say that we are very client-centric business. Meaning that we listen to our clients and our users, and for example, we had a lot of demand for a REIT-based solution, so a REIT investing. So what I ended up doing was, we ended up working with Singapore Exchange, the SGX, to bring a solution, the first of its kind actually, bring a solution to market where investors can get access in an easy, accessible way, low-cost, easy, accessible way to the REIT market. And thirdly is, I suppose, our true advisory team. So we don't just have customer support, which we have customer support, but we don't just have them. So we actually have a true advisory team, which are, as I mentioned earlier, are licensed, experienced advisors that have come from, great backgrounds themselves, have been in the wealth management and banking industry for many, many years. So these guys really know their stuff, and they're able to provide guidance and help you in your investment journey.
All right. So there are a few more questions, but I think we are running out of time. The questions are mostly related to the market. So, I think we can, skip that for this session, because, the focus was more on investing basics and more, to do with a basic introduction to SIFE as well. So sorry, everyone, if we have not been able to answer your, market-specific questions during the webinar. But as Francis had mentioned, feel free to reach out to us directly. through our portal. So, then essentially you can, post those questions directly one-on-one, talk to our financial advisors, and hopefully we should be able to, answer those for you. So again, I'll go back to the screen. So there is this Q&A section. Feel free to, leave a review, as well as if, there are some pending questions that we could not get through to you, you can leave your number and we can, reach back to you. Otherwise, if, still you have further questions, as I said earlier, go to our website, www.sift.com. And essentially, there is a very easy way for you to sort of, get expert financial advice by just visit on the top page. There is an advisory section. So, feel free to just schedule a free call and we'll be happy to take your questions there as well. All right, that's it for today. Thank you so much for joining our session. Francis, thank you for covering this topic. And, again, feel free to join in again next week.
Okay, thank you guys. Have a good night. Take care. See you. Bye-bye.